the Bank of Canada does not want Canadians borrowing any more money. This is the conclusion drawn from the Canadian Survey of Consumer Expectations and the Business Outlook surveys.
Every 40% of Canadians come home at the end of the month and go, if I didn't have this $200 that I had in my balance sheet right now, I would be facing bankruptcy. Is that what we're talking about?
Canada is not merely facing economic headwinds. We are staring directly into the abyss of a slow-motion financial catastrophe that threatens the very foundations of middle-class life in this country. The warning signs are everywhere, blaring, impossible to ignore for anyone willing to look past the carefully scripted reassurances coming from Ottawa and the Bank of Canada. Households are teetering on a knife's edge, governments are drowning in red ink, and policymakers are clinging to narrative control while the real economy cracks and groans under unsustainable weight. This is no ordinary downturn. This is the moment when decades of fiscal recklessness, reckless monetary experimentation, and structural denial finally collide with harsh global reality. The consequences will not be gentle, they will be painful. And they are already arriving. Consider the human tragedy unfolding in plain sight. Nearly 40% of Canadians, that is 16 million people, have less than $200 remaining at the end of each month once the bills are paid. That is not a cushion. That is the fraying thread keeping families from outright insolvency. One broken transmission, one flooded basement, one serious medical diagnosis, and millions of households will tumble into the abyss. Consumer insolvencies already shattered records with over 137,000 filings in 2024, and every indicator screams that 2025 and 2026 will be dramatically worse. This is not abstract statistics. This is welders skipping meals, teachers forced to choose between rent and groceries, young professionals crushed before they have even begun their careers. The Canadian middle class is not struggling, it is suffocating. Household debt alone stands at a terrifying $2.6 trillion. Add federal debt exceeding $1.3 trillion and provincial obligations near $2.5 trillion more. And Canada's total debt burden reaches a scale that should send shudders through every responsible citizen. Our household debt-to-income ratio ranks among the most dangerous in the entire developed world. Families are forced to surrender 14 to 15% of their disposable income simply to service existing obligations, higher than in the United States, while carrying mortgages, credit cards charging 22 to 24% interest, and car loans that finance yesterday's necessities, not tomorrow's dreams. Over 2 million Canadians now depend on food banks in a country blessed with some of the most abundant farmland and natural resources on earth. Millions more are maxing out credit cards at predatory rates just to put food on the table. This is not a temporary squeeze, this is systemic failure on a national scale. The housing market stands at the very epicenter of this gathering storm. For years, ultra-low interest rates, massive immigration without matching housing supply, and regulatory chokeholds have inflated home prices into pure fantasy territory. The Bank of Canada itself has now bluntly stated what realtors dare not admit publicly. House prices must fall if housing is ever to become affordable again for ordinary Canadians. Yet that necessary correction will absolutely savage the net worth of millions of families whose primary and often only outdoor asset is their home. Hundreds of thousands of pandemic-era mortgages taken out at rock-bottom rates are renewing right now. Monthly payments are leaping from $1,800 to $2,700, $3,000, and even higher. This represents a brutal financial body blow delivered straight to kitchen tables across the country. Families who budgeted carefully under emergency conditions now face ruinous increases they never signed up for. First-time buyers might cheer slightly lower entry prices, but existing homeowners are watching their life savings evaporate at the exact moment their debt service costs explode. Government gimmicks, temporary GST rebates, and short-term incentives only distort the market further without solving the core problem. Chronic undersupply caused by zoning tyranny, endless bureaucratic approvals, and NIMBY resistance in municipalities coast to coast. Canada desperately needs millions more homes built faster, not more subsidies that simply bid up prices and guarantee an even more brutal crash later. The longer we delay genuine supply-side reform, the more catastrophic the eventual reckoning will be. The Bank of Canada finds itself trapped in an impossible crossfire. Weak GDP numbers, aggressive U.S. tariff threats, and now escalating conflict in the Middle East driving oil prices sharply higher are all pushing inflation upward, even as underlying growth remains disturbingly anemic. Recent surveys reveal that 81% of Canadians now expect inflation to surge further because of these global shocks. The bank is holding rates, warning businesses and workers against feeding a wage price spiral, and quietly continuing quantitative tightening by letting its bloated pandemic-era balance sheet unwind. These may be responsible moves in isolation, but they offer zero comfort to millions of households already drowning in debt. Governor Tiff Macklem and his colleagues understand that monetary policy alone cannot fix productivity collapse, fiscal profligacy, or deep housing dysfunction. Yet their careful selective communication, releasing alarming consumer surveys while downplaying broader systemic risks, increasingly feels like sophisticated damage control rather than honest transparency. When government borrowing crowds out private credit on this massive scale, even aggressive rate cuts fail to deliver real relief to ordinary Canadians. Mortgage rates remain stubbornly elevated. Small businesses cannot secure capital to expand or hire. Young families are locked out entirely. This is crowding out in its most destructive form. Ottawa's insatiable borrowing appetite sucking the oxygen out of the real economy while working Canadians pay the price through higher costs and permanently lost opportunity. Geopolitical shocks have now accelerated the danger. Higher energy and input costs are rippling through every supply chain. Businesses with no alternative left are planning significant price increases. Workers watching their purchasing power evaporate are preparing to demand higher wages. The dreaded wage price spiral, the nightmare scenario the bank has repeatedly warned against, is no longer theoretical. It is gathering dangerous momentum right now. Pre-conflict business sentiment showed fragile hope. Post-shock reality has crushed it. The feedback loop is tightening. Canada's chronic productivity crisis makes escape even harder. Real GDP per capita has stagnated for years. Business investment continues to lag our peers. Our dangerous over-reliance on housing and raw resources leaves the entire economy dangerously exposed to external shocks. Without bold structural reforms, slashing red tape, rewarding work and risk-taking, and fully embracing innovation, this spiral will entrench itself and force far harsher medicine later. Federal spending continues its relentless upward march, with large deficits still baked into the future, despite occasional revenue windfalls from energy prices. Provincial debts compound the national problem. Total public sector obligations have exploded in recent years, fueled by expansive new programs, subsidies, and political promises. The uncomfortable truth that no one in power wants to say out loud is this: you are the one who will pay, not the trust fund elites or those enjoying private Caribbean getaways, but the welder whose mortgage renewal just jumped $1,000 a month, the waitress hammered by carbon taxes on basic groceries, and the small business owner crushed by higher borrowing costs and ever-growing regulatory burden. History delivers a stark and urgent lesson. In the mid-1990s, Canada faced a genuine sovereign debt crisis, with credit rating warnings looming. Through painful but necessary spending restraint, serious program reviews, and pro-growth policies, the country eliminated deficits, restored fiscal credibility, and unleashed a full decade of strong growth and dramatically falling debt ratios. That generation of leaders put country before short-term political comfort. Today's leaders too often choose the opposite path: more spending, more borrowing, more denial. The result is entirely predictable: squeezed living standards, rising insolvencies, and collapsing public confidence. Every single vulnerability now feeds the next. Sky-high consumer debt fuels waves of insolvencies that weaken financial institutions. Tighter credit then slows business investment and job creation. Housing market weakness hammers construction, retail, and related sectors. Massive government borrowing keeps interest rates elevated across the board, perpetuating the entire vicious cycle. An aging population adds relentless structural pressure on entitlements and healthcare spending. Immigration, while necessary, must deliver rapid economic integration and real productivity gains, not just temporary demand support. Credit card debt has reached dangerous record levels, especially among millennials and younger Canadians who feel completely locked out of wealth building. Food bank usage at historic highs in one of the wealthiest nations on earth is a profound national disgrace. People being forced to choose between eating today and paying crushing interest tomorrow signals both moral and economic failure at the highest levels of leadership. Canada still possesses extraordinary strengths, abundant natural resources, an educated workforce, stable institutions, and the rule of law. But even the greatest strengths erode under chronic mismanagement. We must act decisively and without further delay, impose genuine, sustained spending restraint, and pursue balanced budgets over the economic cycle. Slash regulatory barriers to housing supply using federal authority if provinces continue to drag their feet. Reform taxes to reward work, saving, and investment instead of consumption and debt. Refocus immigration policy strictly on high-skill, rapid integration economic contributors. Cut red tape aggressively, especially in energy and resource sectors where Canada holds a decisive global advantage. Demand that monetary policy remain focused exclusively on long-term price stability, never acting as a backstop for fiscal irresponsibility. The Bank of Canada cannot save us from fiscal incontinence or deep structural rot. Its proper role is to anchor inflation expectations and maintain monetary stability. The heavy lifting, political courage, supply-side boldness, and honest adult conversations about trade-offs belongs to our elected leaders and to citizens who are finally willing to demand better. The $200 margin that millions of Canadians are living on is simply not sustainable. The mortgage shockwave now slamming into kitchens from coast to coast is not manageable without real relief. The relentless accumulation of debt, both public and private, is not infinite. We are standing at the edge. Denial, deflection, and sophisticated narrative management will only make the eventual fall steeper and more destructive. Canada has successfully reinvented itself before. The Laurier vision of opportunity, limited but effective government, and individual enterprise built a great nation. The tough reforms of the 1990s proved that confronting fiscal reality produces genuine national renewal. We can choose that path again through honesty, discipline, and courageous reform, or we can continue pretending that the bill will never come due. The Canadian middle class is watching closely. They feel every extra dollar being extracted from their paychecks. They see their children's future prospects narrowing year by year. They know the gap between official optimism and daily financial reality is widening into a dangerous chasm. The time for half measures and political theater is over. The debt bomb is ticking louder than ever. Canada must now choose painful but necessary correction today, or a far more painful and chaotic collapse tomorrow. The window for decisive grown-up leadership is closing fast. History will judge whether we seized it or looked away until it was too late.